Warren Buffett's 2011 letter to shareholders laid out three major categories of investments, as seen through the eyes of a legendary investor. Currency-based investments. These are investments denominated in a given currency. Think bonds, treasury bills, corporate debt, or even savings accounts. These types of investments are generally thought as low risk compared to other financial assets like stocks. However, Warren Buffett is quick to point out that the idea of risk is more complex than it seems. Treasury bills issued and backed by the full faith and credit of the United States government is about as close to riskless as you can get in the investment world. In fact, the interest rate on the US Treasury bill is the riskless rate that many people use in calculating the value of financial assets. But Warren Buffett has a more sophisticated view of risk, which not only incorporates the risk of being paid back in full, in the time and with the interest agreed upon, but also the risk of losing after-tax purchasing power. Take the humble savings account. It's also a riskless investment because most banks have pretty good credit rating and is regulated by the government to make sure that they are reasonably solvent. But if for whatever reason the bank becomes insolvent and goes bankrupt, well, your funds are guaranteed and protected by the Federal Deposit Insurance Corporation, which is backed by the full faith and credit of the United States government, up to a set dollar amount. So your savings account deposit at an FDIC insured bank is reasonably riskless. But anybody who's actually taken a look at the interest they've earned on their savings account will surely be disappointed, as they are a pittance. We are currently living in a very low interest rate environment, and financial assets tied to interest rates, like treasury bills, bonds, and even savings accounts, are paying extremely low returns that evaporate once you take into account inflation, which erodes purchasing power. Warren points out that since 1965, the dollar has fallen a staggering 86%. It takes no less than $7 today to buy what $1 did at that time. And investors in currency-based investments not only have to fight inflation eroding away their returns, but also taxes. So currency-based investments like a savings account or a treasury bill is riskless in the sense that you're repaid with interest in a timely manner, but the risk of a loss in purchasing power is far from riskless. Warren does point out that there have been times in the past, like in the early 1980s, that interest rates were so high that it could combat the eroding effects of inflation and taxes and still produce a healthy return. But currently, interest rates are at near historic lows in many countries, which make currency-based investments a risky proposition. The second major category of investments are assets that will never produce anything, but are purchased in the buyer's hope that someone else, who also knows that the asset will be forever unproductive, will pay more for them in the future. The major asset that Warren Buffett talks about in this category is gold. Now, I remember a few years back when the idea that the idea that we've hit peak oil production and will slowly run out of oil, will end civilization as we know it, gold became a really popular investment due to gold's historically great investment track record when people are fearful. I'm not so sure why gold is so favored by people fearing a dystopian future. True story, I had a coworker once ask me, wouldn't I want some bars of gold if society collapsed? I told her no, if society collapsed, I'd rather have a cow, seeds, farming tools, clean water. In all honesty, gold would be the last thing I would want. That's gold's problem. Its uses are very limited, some industrial use and jewelry. It also doesn't produce anything. If you own 1 ounce of gold for an eternity, you will still own 1 ounce at its end. Gold's value largely depends on the sentiment of other investors, somebody who thinks gold's price will rise even further in the future because the utility of gold is very limited and unable to keep up with supply. I think Warren Buffett puts it quite beautifully in his letter to shareholders the problem with gold and assets like it. Today, the world's gold supply is about 170,000 metric tons. If all this gold were melted together, it would form a cube of about 68 feet per side. Picture it fitting comfortably within a baseball infield. At $1,750 per ounce, gold's price at the time of this writing, 2011, its value will be about $9.6 trillion. Call this cube pile A. Let's now create a pile B costing an equal amount. For that, we can buy all the US cropland, 400 million acres with output of about $200 billion annually, plus 16 ExxonMobils, the world's most profitable company, one earning more than $40 billion annually. After these purchases, we would have about $1 trillion left over for walking around money. No sense feeling strapped after this buying binge. Can you imagine an investor with $9.6 trillion selecting pile A over pile B? A century from now, the 400 million acres of farmland will produce staggering amounts of corn, wheat, cotton, and other crops, and will continue to produce that valuable bounty, whatever the currency may be. ExxonMobil will probably have delivered trillions of dollars in dividends to its owners and will also hold assets worth many more trillions. And remember, you get 16 ExxonMobils. The 170,000 tons of gold will be unchanged in size and still incapable of producing anything. You can fondle the cube, but it will not respond. The third major investment category are productive assets. Now, those that know who Warren Buffett is probably think that he's talking about stocks and companies. True, stocks in well-managed, financially sound companies certainly produce assets, both in terms of dividends and earnings to its shareholders. The capital gains on stocks can be the financial cherry on top of the investment sundae. Warren Buffett points out that the Dow in the 20th century increased from 66 to 11,497, and at the time of this video, the Dow is at 20,668 and paid loads of dividends. A company's earnings are also hedged against inflation because the prices of products and services they sell will go up with inflation. Also, capital gains and dividends are generally taxed more favorably than regular income, and doubly so if the stocks are held in a tax-sheltered investment account like a 401k and IRA. Now, the problem with stocks and equity investments is which company do you invest in or which investment vehicle do you invest in, but that's a whole other video. But productive assets isn't limited to just stocks. It also includes real estate and farmland. Warren Buffett has invested in both. In 1986, he purchased 400 acres of farmland north of Omaha. Farmland's productive capacity is quite easy to understand. We all got to eat. In 1993, Warren Buffett, along with a small group of other investors, bought a retail property that was adjacent to New York University, figuring that the university wasn't going anywhere. Annual distribution from this retail property now equaled 35% of his initial investment, and he also enjoys special distribution that totaled more than 150% of his initial investment. He hasn't even visited the retail property once. Unsurprisingly, Category 3, or productive assets, is Warren Buffett's preferred investment type, and frankly it's also mine. Thanks for watching. Please subscribe as I'll be making more videos that detail Warren Buffett's investment philosophy from his annual letter to shareholders. Till next time.